More than 50% of GTA condo owners are losing money on their pre-construction project. Guess what? Because when they booked the unit, the rates were at the bottom and the prices were higher, and as they are closing those projects to rent it out, the expenses on that project is not covering up the rent. So they are putting the money out of their pocket. As long as they can keep the unit, it's okay, but if they are not able to cover those expenses, they will have to actually sell the property to cover up their expenses. So that's the state of the pre-construction projects in GTA, especially if you have closed in the last year or so. And this is where the Bank of Canada's rate hikes are kind of killing the potential profit the investors were looking at when they were booking those pre-construction projects. In addition to that, what we saw that the housing market is kind of losing steam. We saw in the last 2 months the acceleration in terms of the price and the multiple offers. We're seeing that process is kind of curving, sideways, and the reason could be is as people are moving into summer, their priorities are going to be changed, because now they're not looking to acquire the property because summer is about vacations, moving around and not focusing on a house move. So my suspicion and my perception is that higher acceleration that we saw in the prices in the last 2 months is kind of subsiding now, as the demand is kind of losing its steam. Could be wrong, but this is just my early observation. In addition to that, we saw our Canadian banks, the big 5 banks, are now securing extra funding to prepare for a storm that could come their way when the default come on those mortgage loans. You see that how the Canadian banks are basically allocating extra funding to cover up any potential default on those mortgage loans. So TD Bank, $599 million compared to typically $27 billion annually. BMO, look at that, $1.02 billion of credit losses that they are anticipating. Typically they anticipate up to $50 million annually. So there's a massive difference in terms of what they prepare for in a typical year versus what they're preparing for now in terms of seeing a potential credit losses on those loans. So this shows you that these banks have insights which maybe we don't know, that they are preparing for that kind of a potential credit default. When you see negative amortization, when you see 50% of the condo investors are losing money, when you see the average payment on the mortgages have gone up by 40% or going to be 40% next year or so, these banks are looking at that storm being built up in the Canadian economy, especially for the households, and now they are preparing for that cover. When it happens, they should have some liquidity available to cover that losses. That's the state of the banking system, which is highly leveraged. And remember, last week CMSC published a report where they just came out of woodwork saying that Canadians have the highest debt load compared to G7 countries. And I said, well, CMSC, where you were hiding? We know that, for the last decade or so, the Canadians have been piling up debt, crazy compared to their counterparts in the G7. And now we're seeing that the debt to GDP ratio for Canadians is over 100%. The standard is, if you are under 70% on your debt to GDP ratio, you can come back. But as you cross that threshold, there is no way to pay back that debt unless you default on that loan or you inflate it away. So prepare for either of these options if we wanted to get out of that situation. So this Wednesday, Stats Canada is going to announce their new GDP print, and this will have a potential impact on Bank of Canada's next rate hike. As I mentioned in my last video, where the higher inflation reading for the month of May could potentially put the rate hike program back on the table for Bank of Canada. A lot of things could happen. The GDP data may influence that. If the GDP data comes negative, then of course that's a strong enough evidence that the economy is slowing down. Or if the unemployment goes up, which is also we are looking at it Right now, this is not being reported in the Stats Canada's figures, but in my opinion, we are seeing job losses happening, and the labor market is being very, very competitive, and it's moving from being competitive onto having some surplus available. So we'll see in the next week or so how the GDP and the unemployment data and the next CPI comes along. That will shape up the Bank of Canada's rate hike decisions. So until then, I'll see you in my next week video.